It's not very often you see such an interesting week in the market. 5 consecutive down days after 9 weeks of gains. December was an amazing month, the actual definition of a melt up, but the dark pool and gamma transactions we've been getting is raising some concerns. There's a big focus on healthcare and consumer defensives, and we need to talk about it. Is this just buy the losers of 2023 or a more sinister defensive rotation occurring under the hood? So stay tuned as we cover everything you need to look out for. Hello everybody, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like these videos, please subscribe, hit the like button, hit the notification bell. Let's get into it. Another red day for the S&P 500 led by technology and the big names. However, Nvidia and Meta outperformed, but Amazon the real loser. But we saw the continued bid in healthcare as well as financials, although Berkshire took a bit of a break, giving some of its gains back that it made over the last few days. Energy was an absolute shocker of the day on the EIA inventory builds, and regional banks in financials outperforming. But I think the reason why healthcare and financials were bid up today is that participants are looking at things such as earnings growth as well as current valuation. Healthcare is expected to grow earnings in calendar year 2024 at 19.1%. Financials only 6.6%. But the reason why financials look attractive is because on a PE basis, it's trading at a 14 PE. Very, very cheap. And I think this is why we're seeing a bid in financials and healthcare. Looking at the majors, look at the best performing indice, RSP, the best performing index out of the IWM, the SPX, and the NDX. Here are the sectors. Regional banks, healthcare, the top performing sectors, up 0.5 percentage point. And the winners of last year, we're really seeing them being sold off quite substantially this week. And we've been trying to decide if we are seeing a defensive rotation or just a rotation from 2023's laggards. And I think what we're actually seeing is less of the defensive rotation and more of 2023's laggards. If we were seeing a defensive rotation, we would really see more of a bid in staples as well as utilities. And I think a lot of the selling we're seeing today had to do with the dollar. The dollar came off its lows overnight in European trade on reduced rate cut bets. See, if rates remain higher, it's best to hold dollars, and the king of dollars is the greenback, and that's why the US dollar was bid up. And this is particularly bad for overseas earners as the exchange rate impacts their earnings negatively, as well as energy companies. But we got the latest sentiment survey today, and bullish sentiment is still there. The bears did tick down ever so slightly, but we are seeing a normalization of some sort in those that are bullish and those that are bearish. We still are well above the historic average. While bullish sentiment did increase, fund managers actually decreased their equity exposure, the NAM number. This is essentially the equity exposure of active fund managers, and they're now sitting at about 70.95%. And the sell-off we've seen today has coincided with the equity exposure in active fund managers. And we've seen this decrease in equity exposure coincide with a spike in yields. The 10-year especially is very close to 4%. Look at the 20-year was at 4.1% just a couple of days ago, now at 4.3%. Yields have really rallied over the last 4 to 5 days, and I think it's because the market misjudged the speed and depth of rate cuts. But I do think that the 10-year right here at 4% is where we're going to see resistance for yields and support for bonds. Now let's talk about the Santa rally. We posted a negative Santa rally, negative 0.884%. Most of the selling coming from the last 3 days in the period. And the reason why this is so important is because January is normally a great barometer for what's going to happen in the rest of the year. No Santa rally increases the risk for a down January. When we have a negative Santa rally, on average we see a negative January of 0.38%, median returns negative 1.29%, and generally is only higher 45% of the time. But when the Santa rally is positive, average returns of 1.63%, 66% of the time it is higher. And this actually extends to the quarter and half year periods. When the Santa Claus rally is negative, we normally see a negative Q1 of 1.23%, but in the opposite case, when the Santa rally is positive, we see a positive quarter of 2.28%. And in both instances, it's only higher 40% of the time when Santa rally is negative. Positive, it's higher 65% of the time. Very, very interesting. And it's kind of the same results for the first half of the year. Negative 7.4% for a negative Santa rally and positive 4.85% when we get a positive Santa Claus rally. And it just goes to show that this first week in January, or this period here in the Santa rally, is a really great barometer for what's going to happen in the year ahead. And this right here actually positively correlates to what we can expect in an election year. As you can see, the first quarter and potentially the first half of the year is actually quite weak during an election year. We normally get modest to flat returns all the way up until May, where we do see a dip around the March-April period. And this is what we're going to look for. Now, an election year normally is positive. We get returns anywhere from 8 to 11% every single year. And it does look like any dips that do occur this early in the year should be bought for continued strength towards the end of the year. Let's switch gears, look at the macro. Tomorrow we get non-farm payrolls. 175,000 NFP number is expected. 50,000 of that is going to be government employment. And Goldman Sachs think we can actually beat this number. Goldman Sachs believe we can actually see 190,000 in non-farms tomorrow against the consensus of 175. They also estimate that the unemployment rate is unchanged at 3.7% and average hourly earnings increased 0.3% month over month, but that lowers on a year-over-year basis to 3.9%. And that's actually good because wage inflation is decreasing, and this is what the Fed wants to see. They want wage inflation in the 2 to 3% rate right there. Now, some good news for GDP now. The GDP estimate for 2003 Q4 increased from 2% to 2.5% overnight. And the majority of this increase has to do with the Red Book numbers for January. We can see that Red Book is at 5.6% and it's actually been trending upward, and it looks very, very healthy, all things considered. And we also got great employment numbers yesterday. ADP beat 164,000 private payrolls versus 115K consensus. And the same is true for jobless claims, 202,000 versus 216 consensus, and also a beat on continuing claims. Along with this, job openings are high everywhere. It isn't concentrated in one sector, which is skewing the numbers. Job openings across all of these industries are incredibly high. And if we actually have a look and compile all of this on a bird's eye view and look at the data holistically, this is what we get. Payrolls increasing, labor force increasing, claims flat, job openings decreasing. Now, a lot of people point this out as the negative data point and say recession. But with payrolls increasing and labor force increasing by 4 million and 5 million, job openings should decrease. These openings need to be filled. Now, answer this question. Does this look like this? This is 2007, the GFC. We could see here that payrolls and openings fell. Claims increasing, payrolls decreasing. Does this look like this? Let's compare it to the year 2000. Claims rising, payrolls decreasing, job openings decreasing. Does this look like this? It does not. Adding fuel to the fire, United States jobs quits. This is where we are right now. The lowest level in a year, as well as jobs cuts. 36,000 jobs got cut in December. The forecast was close to 40,000, and this is actually the second lowest level in a year. Let's keep moving on the macro, looking at consumer spending. Consumer spending in 2023 actually looks about where it is at the average, but we actually beat 2020, we beat 2019, we're just below 2021, and we're in line with 2022 for pretty much the September, October, November, and December period. And all of this data, guys, all of this data together is pointing to no recession. And the question I get a lot is that if the economy is so strong, why do we need rate cuts? And it's quite simple. CPI right now on a 6-month annualized basis is at 2%. Federal funds is at 5.5%. That means real rates are too high. Real rates is at 3.5%, whereas CPI is at 2%. We generally want real Fed funds below the CPI. So few people understand this. And if the Fed cuts rates and we don't get a recession, which is this blue line right here, what we can normally see 12 months later is equity returns in the S&P 500 of 8 to 10% 12 months on. Very, very bullish. Now guys, let's switch gears, talk about financials. We got this note off the BofA trade desk, and BofA are bullish on banks. Take it with a grain of salt. Bank of America is a bank, but they say 50% upside on a PE reversion to pre-pandemic levels. We see potential for an overshoot in bank stocks with a return to pre-pandemic PE, implying a 50% average upside on 2025 consensus EPS. Our investor conversations indicate an appetite to add exposure to the group on rising probability of a soft landing. Ingredients for a continued move higher include increased confidence that interest rates head lower, watch inflation, the economy avoiding a recession, watch jobs, and GDP accelerating. They also see the same for regional banks, and here's some data supporting this, right? In 2024, S&P 500 companies are expected to spend significantly more than in 2022 and 2023 on M&A as well as buybacks. And buybacks and M&A are the two highest margin businesses for banks, and this is going to be a tailwind for banks in 2024. That's the macro. Let's look at the technical, and looking at gamma, we continue to be in a negative gamma condition. There's quite a lot of negative gamma coming into the tape, with the put support or the put wall being 4,600 at the moment. We are sitting just about here. So the very first level I want you guys to look at is 4,650. Very likely we get there tomorrow if the downside trade continues. We could see a bit of a short covering rally, people covering their shorts into the weekend tomorrow, but 4,650 should be the major level we look at, and then 4,600. Let's have a look at some of the charts, and we currently closed at 4,688 in the S&P 500. We actually made a lower low, closing below this level right here, and this kind of looks bearish. And right here, this is where the 4,650 area is, just above here. We probably end up getting there tomorrow. We could like gap down to that area, bounce on a short covering rally, or maybe we cover shorts and then continue selling the 4,600 area. All in all, it does look like bears are in control for now. And if bulls want to get in control, they really want to push to this 47, 45 level and build support right there. That's what they want to do. Looking at the RSP, and it's holding up really, really well, I have to say. And it's above 155. I can't be bearish on the RSP above the 155 level. If it breaks below here, closes, maybe even 2 or 3 days worth of closes below this area, we can then look to 150. But as it stands right now, the RSP is performing the best. TLT, I do think that the 10-year treasury at 4% is probably where we're going to see resistance in yields, support for bonds, and it seems that that level is right on the 200 moving average for TLT. So maybe we see a bit of support here. Like I said, I am bullish on TLT as long as we're above the 200 moving average, looking at a price target of 109. And here's the dark pool activity for TLT. We saw a huge trade coming at the end of day after we saw these big trades right here, 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 and here. We did get this fake out, then this massive trade came in, probably a short, and now we're seeing funds add exposure or potentially closing their shorts. Looking at the IWM, this looks bearish, and particularly we get even more bearish if we close below this level right here, 193.57. We close below there and it's probably 188, 187, 186 for the Russell 2000. Financials, incredibly strong, up 0.4% on today. And the crazy thing about this was Berkshire was in negative and financials still pull up a good day. So there was broad-based buying in financials. As long as we stay above the 3704, and we could even go like to the 3680 level right there. We stay above these levels and I'm bullish on financials to get to $40, $41 Q1, Q2 this year. Bitcoin, we said we were waiting for this wedge pattern to play out. It's played out on both sides. Now what Bitcoin bulls or Bitcoin bears need to do is look at this, right? And you're either going to play below, play above, but you don't want to take trades anywhere between. Pick a side, manage your risk, go for it. Amazon, we built an island up here. It's now turning over. If we do close below this level right here, we're sort of at that resistance. That's where I would probably get bearish. But I do think that's where I would probably get bearish and look for prices in the mid 130s, maybe 137, 138 for Amazon. Metals, this kind of looks bearish. The breakout thesis did work. If you took this breakout, you made 6 to 7%. Pretty good. This looks kind of ugly, but looking for the rest of the year, as long as we stay above this line, maybe move upward, the bull thesis could very much be alive. Visa's holding in there. Visa is really holding in there. I mean, it's not seen the selling that most of the market has seen, especially in technology. The same is true for real estate. This kind of looks like the equal weight chart. Even though yields have gone up 4 to 5%, like 30 to 40 basis points over the last couple of days, over the last week or so, we have seen real estate hold in there and still very bullish. When you look at this chart, it's sort of just testing and building a support base right here. Anything can change if it does break below the 38 level, but all things considered, constructive price action for real estate. And we're also seeing this in some of the hyper growth names. They're kind of like avoiding the sell-off. I mean, Celsius holding is up 2.15% today. I would love for it to get to the 50 area, but holding up very good regardless. NEO, and we said selling is going to come at this level. It has. We saw a bit of a short covering rally, and we're probably going to look for the 7 area before we do any buys. It was down 2.17% today, and it's probably going to go lower, guys. PayPal, we've had 3 rejections here, and now here. Maybe we can look to the 55, 52 area for potential buys, but I'm not interested in PayPal. I'd rather hold a stock like this for the long term, and the fundamentals don't support the thesis in holding PayPal. BABA, what I want to see in this stock is a break above the 200 moving day, find support, and then we can look for trades. Do not buy the stock right there. Don't invest in China. Not worth it, guys. Looking at data tomorrow, we've pretty much broken it down. It's going to be non-farms, average hourly earnings. There's a couple of ISM, but if you've made it up until here, thank you so much for watching. Please subscribe, like this video, hit the notification bell. Cheers.